Okay, let's unpack this. The Federal Reserve just made headlines by cutting interest rates for the first time in 9 months. A lot of people expected a cut, but the reasoning is where it gets really fascinating.
Right. Fed Chair Jerome Powell called it a risk management cut.
Which just begs the question, what does that actually mean? Especially, when inflation is still well above their target. It's a statement that needs a closer look.
It really does. And what's fascinating here is the nuance. This wasn't unanimous inside the FOMC.
Yeah.
And the specific rationale they offered gives us a really important window into how the Fed is trying to balance things. It's not just the economic data anymore.
No, there's this huge political pressure element too, right? Unprecedented, really.
Absolutely. It paints a very complex picture for the economy, obviously, but also directly for you, for your finances.
So today we want to unravel the story behind this specific decision. We'll get into the details of the cut, Powell's surprising explanation, those conflicting economic signals they're dealing with.
And the political drama swirling around the Fed, which you can't ignore. Plus, how markets took it all in and what it might mean for borrowing costs going forward.
Yeah, exactly. By the end, you should have a much clearer understanding of what just happened, why it matters, and sort of how it might play out.
Let's do it.
So let's start with the basics. The Federal Open Market Committee, the FOMC, what exactly did they decide yesterday?
Okay, so the vote was 11-1. They decided to lower the target range for the federal funds rate by a quarter of a percentage point, 0.25%.
Okay.
That brings the new range down to 4.00% to 4.25%. And like you said, it's significant because it's the first cut since, I think, December 18th, 2024. So, yeah, 9 months of holding steady just ended.
And what did they say in this statement? Anything stand out?
They mentioned being attentive to the risks to both sides of its dual mandate. That's maximum employment and price stability. But the key phrase was they judged that downside risks to employment have risen.
Downside risks to employment. Okay. So that points towards the rationale later. But that 11-1 vote, it catches your eye immediately. Who was the one dissenter, and what was their argument?
Yeah, that's a really interesting part of the story. The lone dissenter was Stephen Mirren.
Ah, the recent Trump appointee. Sworn in just the day before, right?
Exactly. He was President Trump's top economic advisor. But here's the twist. He didn't dissent because he wanted no cut, or a smaller one. He actually pushed for a bigger cut, 0.5%, 0.50.
Wow. Okay, so more aggressive easing. That's quite a statement for your first vote.
It really is. And it's also worth pointing out that Governors Bowman and Waller, who were also Trump appointees people were watching, they actually voted with the majority for the quarter-point cut. So it shows the appointees aren't necessarily voting as a bloc. But Mirren's dissent definitely signals a different view on how urgently the economy needs support.
Definitely tells you something about the range of opinions inside the room. Okay, so let's get back to Powell's phrasing. This risk management cut, it sounds very deliberate. What risks was he pointing to?
It does sound deliberate, and he was explicit. This is risk management, not a reaction to, clear economic weakness that's already hit us hard. His main focus, the labor market.
The jobs picture.
Yeah. He described it as really cooling off. He talked about a marked slowing in both the supply of workers and the demand for them. He even called that combination unusual.
Unusual. So it's preemptive, trying to stop something worse from happening in the job market.
That's exactly the framing, getting ahead of a potential downturn. He also mentioned this move puts policy in a more neutral position, moving away from actively restricting the economy. That's a subtle but important shift in language.
More neutral. Okay, so less foot on the brake, maybe. And what data was underpinning this concern about jobs really cooling off?
Well, the data certainly backs up the concern. That August jobs report was, frankly, a bit of a shock. Only 22,000 jobs added.
Yeah, that was way below expectations.
Way below. And the unemployment rate ticked up to 4.3%. That's the highest it's been since October 2021, if you ignore the pandemic spike itself.
Right.
And look at the trend. So far this year, about 598,000 jobs added. Compare that to the same period in 2024 that was 1.4 million. Big difference.
Huge slowdown.
And then there were the revisions. They revised earlier data showing almost 1 million fewer jobs created in the year leading up to March 2025 than they first reported.
Oof. 1 million fewer.
Yeah. So you put all that together, it strongly suggests the Fed is seeing real significant softening. They're trying to prevent that cooling from turning into, a deep freeze.
That makes sense. The jobs data is compelling, but,
Right.
and this is the big but, what about inflation? The other side of their mandate, isn't cutting rates pouring fuel on that fire when it's still burning pretty hot?
That is the paradox, isn't it? It's the absolute tightrope walk. Cutting rates usually boost demand, potentially pushing prices up, and inflation is still above their 2% target.
What was the latest PCE number?
The Personal Consumption Expenditures Index, their preferred gauge, hit 2.9% in August. So yeah, clearly above 2%.
And Powell acknowledged this, right? He didn't pretend inflation was solved.
Not at all. In fact, he specifically warned that he expects inflation effects on goods prices to continue to build through the rest of this year and into 2026. He pointed to goods prices as the main driver of overall inflation this year.
So they're cutting rates while warning about inflation building. That requires some careful explanation.
It does. It's a very delicate balancing act. They seem to be betting that the slowdown in the labor market is a more immediate risk, and perhaps that inflation, while sticky, might not accelerate wildly from this cut.
What about tariffs? We've talked before about how those could push up goods prices. Did Powell mention those?
He did. Interestingly, he suggested the Fed now thinks the pass-through effects from the Trump administration's tariffs are proving to be smaller and slower than they maybe expected a few months ago.
Smaller and slower.
Okay. So while they still expect inflation to move up, maybe, he said not as much as we would have thought a few months ago. It sounds like they've slightly downgraded the expected inflationary hit from tariffs.
So they're trying to manage these inflation expectations while dealing with the very real slowdown in jobs. It's unenviable.
Completely. And then you layer on top of all this economic complexity the politics.
Right. You can't really analyze this decision without talking about the political backdrop. It's been intense.
Intense is putting it mildly. For 9 months straight, President Trump has been very publicly criticizing Powell. NBC News called it an unprecedented pressure campaign.
Constant calls for rate cuts.
Yeah.
Trying to reshape the Fed board itself.
Exactly. It puts that core principle of central bank independence right under the spotlight. How independent can they truly be under that kind of sustained public pressure?
And it's not just tweets, right? There are actual battles playing out. The Lisa Cook situation, for example.
Absolutely. That's a really stark example. Trump moved to fire her over mortgage fraud allegations, which she strongly denies. And just last week, a federal judge stepped in, issued a preliminary injunction saying, essentially, she stays on the board while this legal process unfolds.
And yet she voted with the majority for the cut, despite all that.
She did, which is fascinating in itself. It's also worth remembering, the law says presidents can remove Fed board members for cause, but it's never actually been done successfully in the Fed's entire 112-year history. So this is pretty serious territory.
It really underscores the tension. And then, as we mentioned, Stephen Mirren, confirmed Monday, sworn in Tuesday, dissents Wednesday.
Right. His confirmation was tight, 48-47 in the Senate. And given his background as Trump's CEA chair, even though he pledged independence, questions about loyalty were immediate.
Senator Schumer called him Trump's mouthpiece at the Fed.
He did. And Mirren's immediate dissent, pushing for more cuts than even Powell wanted, certainly adds fuel to that fire. The bigger question all this raises is about the long term. Does this kind of political environment erode trust in the Fed's decisions? Does the market start trying to guess political motives instead of economic ones?
That's a really critical point. If perception shifts, it changes everything. So, okay, you've got the jobs data, the inflation paradox, Powell's careful phrasing, the political heat. How did the markets actually react when the decision in Powell's press conference hit?
Well, it was volatile. Almost a textbook buy the rumor, sell the news kind of day. Initially, stocks shot up. The Dow jumped, almost 480 points at its peak?
Yeah, a strong initial reaction.
But then, during Powell's press conference, as people started digging into his words, that caution, the risk management angle, the mood shifted.
Turned negative?
Completely. The Dow gave back all those gains. The S&P 500 ended down about 0.8%, the NASDAQ down 1.2%.
Ouch.
Interestingly, though, the Russell 2000, which tracks smaller companies...
More sensitive to rates, usually.
Yeah, exactly. It actually finished up 1.2%. Maybe the market thinking lower borrowing costs help smaller businesses more directly. Hard to say for sure.
And bonds. And the dollar.
Similar whipsaw.
Yeah.
The 10-year Treasury yield dipped below 4% for a bit, then bounced back. The dollar index did much the same. It really suggests the market might have been hoping for, or had priced in, a more clearly dovish signal than Powell actually gave.
So the market wanted more certainty, maybe more aggressive cuts signaled. What does the Fed's own forecast, the dot plot, actually show now?
Well, their updated projections, the famous dot plot, it shows officials do expect more cuts this year. The median forecast is for 2 more quarter-point cuts before the end of 2025.
Okay, so likely October and December meetings.
That seemed to be the base case. But, and this is important, there's a deep split revealed in those dots. 9 members see only 1 more cut this year. 10 members see 2.
Almost evenly split.
Very close. And remember Mirren's dot. That apparently signaled much more aggressive easing than anyone else.
Right. And what about next year, 2026?
That's where there's a potential clash with market hopes. The Fed officials project only 1 quarter-point cut for all of 2026.
Just one, when markets were pricing in.
Markets, or at least futures traders, have been pricing in maybe 2, even 3 more cuts next year. So the Fed is definitely signaling a slower pace of easing than the market was anticipating for 2026. That gap could cause more bumps down the road.
Yeah, that's a significant disconnect. What about their actual economic forecasts? Unemployment, inflation, are they still shooting for that soft landing?
They're definitely still aiming for the soft landing, bringing inflation down without crashing the economy and causing mass unemployment. But their forecasts show it's a tricky path.
How so?
They see unemployment rising a bit more, from 4.3% now to 4.5% by the end of this year, then sort of leveling off around 4.4% next year, 4.3% in 2027. So they expect some more softening, but not a huge spike.
Okay, manageable perhaps, and inflation.
They see PCE inflation finishing this year at 3%, still above target, then slowly receding to 2.6% next year and 2.1% in 2027. Core inflation, stripping out food and energy, they see it 3.1% this year.
So still a ways to go to get back to that 2% target on inflation.
Absolutely. It suggests they believe they can cut rates cautiously to support jobs while inflation gradually cools. But gradually is the key word. And there's so many things, including politics, that could knock that off course. It's a tough needle to thread.
So putting it all together, the Fed's walking this incredibly fine line, cutting rates, calling it risk management for the labor market, but inflation is still high, and the political noise is deafening.
It really feels like a unique moment. You've got the economic crosscurrents, the political pressure, fundamental questions about central bank independence.
Yep.
It's all happening at once. And that gap between the Fed's cautious view and what parts of the market seem to want could mean more volatility ahead.
For you, the listener, really trying to understand these different forces, the economics, the politics, the Fed's own messaging, it's crucial for making sense of where things might be headed. This decision touches everything from mortgage rates to maybe your job security.
It makes you wonder, is this the start of a new Fed playbook? More proactive on employment risks? Or just a temporary response to very specific circumstances right now?
Good questions. What stands out most to you from all this? What questions does it leave you with about the economy or the Fed itself?
Definitely something to think about.
And if you are listening on YouTube, please do like this conversation and subscribe to the channel for more analyses like this one. If you're on Spotify, a follow would be great so you don't miss our next discussion. Thanks for joining us.